We're back with the $700 billion bailout plan looking like it will pass. The big question is, will it be enough to turn the economy around? According to our CNBC Wealth in America survey, more than 90% of the respondents describe the economy as either poor or fair right now, but there's a big jump in expectations for the economy next year. Joining us with his insights, Peter Boockvar, equity strategist with Miller Tabak. Peter, good morning. Thanks very much for being with us.
Hi, Mark. How are you?
Pretty good. You do not favor this plan, do you?
No. I want to start by saying that we all want this mess to end as quickly as possible. It's just a question of what the means to the end is. In my opinion, number one, it's a bailout of the previous failed bailout, which was a bailout of the previous failed bailout, etc. And that we have to put that into context, that every time government has gotten involved here, it's made things worse. We've had unintended consequences that the next bailout was trying to fix. Number two, it doesn't fix the core problem, and that is house prices are going down. And this plan is not going to make people to go out and buy homes. We've seen mortgage rates have even gone up after this plan was announced. We've seen, even after the Fannie Freddie conservatorship, mortgage rates go higher.
But nothing is going to do that, Peter.
Well, in my opinion, everyone's looking for this magic button to press, or this silver bullet to end this whole mess. It's this: we have to do something, instead of letting the economic cycle run its course. And
all right, no, stop right there. Hold on a second. Okay, we're following you so far. Here's the problem that everyone, or most people, say when you say, look, let the market run its course. They say, Paulson and Bernanke certainly say, we are on the edge of a financial meltdown or a financial seizure that would be catastrophic in its results, and therefore we can't let the market run its course. Now, what's your answer to that?
Well, last night I went and looked at 20 of the top U.S. financial institutions in this country. They pay about $40 billion worth of dividends. The rule of thumb being for every dollar of capital, you can lend out $10. That's $400 billion of lending capacity that these banks can provide. That's more than half of the Paulson plan and would cost taxpayers zero. So this belief that the world is going to fall apart, the financial markets are going to collapse, we're going to go back to the Stone Age if the government doesn't come bail us out, I think is a fallacy.
Peter, I'm sorry, could you just walk through where you get that we have $400 billion from the banks right now? I'm not being a jerk. I just want to make sure I understand it.
No, I looked at 20 of the top banks. I included Goldman, Merrill, and Morgan in that. They're paying a combined $40 billion of dividends annually, almost $40 billion.
Okay, that's
so
40.
For every dollar of capital, they can lend $10 worth. That's $400 billion of lending capacity if they stop paying their dividends.
If they can lever up, and right now that's the whole problem, right? $1 is $1. $1 is not $10 anymore.
Well, they're lent even if it's $7. That's almost $300 billion. And I'm only including 20 banks, and I'm not even including or taking away the stock buybacks that they continue to take part in.
But Peter, and believe me, I'm very sympathetic to your argument. I don't think this bailout's a good idea either. But the fact is, they have that money, but they're not lending it. That there's panic in the marketplace.
The problem is the collateral that's backing these assets, and this government plan doesn't address the fall in that collateral. Home prices are still going to fall. Bank of America is not going to change their lending standards to a consumer just because their balance sheet looks a little better today than it did yesterday. They're still going to want 20% down. They're still going to want you to document your income in order to get a mortgage.
Hey,
so that's
Peter,
not going to change.
Peter, it's John Harwood in Washington. The administration, the president, Hank Paulson say if this does not get done and the market realizes it's not getting done, credit is not going to flow. Businesses cannot get the liquidity to pay their employees. People can't get mortgages and they can't get car loans. Tell me how they're wrong in assessing that.
Well, again, this is a deleveraging process that's going to happen no matter what, whether the government gets involved or not. To me, the panic that precipitated
that's flat not going to happen, in your opinion.
No. I've been a bear for a couple of years. I was called a doomsayer in 06, 07. I'm somewhat calm now, and everyone that has been positive are now the doomsayers. We have to look at what got us here. I'm of the opinion that the Fed's attempt to save the system with their TSLF and PDCF facilities gave the investment banks a false sense of security that they can take their time in delevering. It slowed down the deleveraging process, which eventually obviously brought down Lehman and brought Goldman and Morgan to the position that they're at now. Without that bailout, I think we would have been much further along in this deleveraging process, and we would not be discussing a $700 billion bailout today.
All right, we have to leave it there. We're out of time. Peter, thank you very much for sharing your thoughts.
Thank you very much.